that I think gold's going to be the developing market sort of going to be their currency moving forward. It's going to be what they settle trade in, and when kind of understand that's going to be a big driver for its demand, then kind of come up with some crazy prices. Because
so Ferg, in this fiscal dominance project Zimbabwe scenario that is being laid out here, where does gold, silver, copper, the S&P, NASDAQ, like how high do they go?
I never use price targets because I'm just not smart enough to know that. Yeah, I always feel price targets kind of lead you astray. My metrics are more supply demand, and I'm also focused really heavily on sort of market behavioral, market like sentiment, like how everyone is, like if everyone's kind of super excited, build up, everyone has to be in. It's kind of front page on magazines, taxi drivers turning around. Like I take a lot more of that. I've always loved John Templeton's kind of maxim that bull markets are born in pessimism, grow in skepticism, mature in optimism, die in euphoria. And I kind of feel you should always understand whatever you're getting into, where it sits on that scale, and you want to be pretty far gone by the time you're starting to see signs of euphoria.
That's really good. Yeah, that's really good. It leads me to believe that we're talking multiples from where we are right now because of just on sentiment alone.
Yeah,
it's so low.
Yeah, 100%. And depends, which commodity and what's feeding into it as well. Like I've got different views on different commodities as well, with some being having quite sort of inelastic demand as well, and so that things could get really interesting. Whereas others, like some battery metals, I'm really not too sure.
So gold and silver have historically skyrocketed after the Fed has cut interest rates. We don't know if they're jawboning or if they're actually going to cut here soon. Silver has outperformed gold during those times, and both of those have crushed the S&P 500 during those times. Do you expect any upcoming Fed rate cuts to basically propel the precious metals much higher?
Not really. I kind of feel I've got like a different view on what's driving gold as well, and that's again sort of borrowing views of Lewis Vincent Garve, Luke Broman, and just what I'm seeing in the market as well, is the fact that I think gold's going to be the developing market sort of going to be their currency moving forward. It's going to be what they settle trade in, and when kind of understand that's going to be a big driver for its demand, then kind of come up with some crazy prices. Because I didn't touch gold in my portfolio for a long time. Only recently have I got some gold exposure, and that was largely due to me viewing it kind of as a political metal. The kind of the way that demand and supply was never allowed to kind of allow price finding. The fact that every time there would just be like the paper gold market would expand and sort of remove any real price discovery. I was like, why do I want to be involved in this when it's obviously not been allowed to trade as it should? And for that to work, you have to control physical settlement. And what we're seeing at the moment is the East, particularly China, taking away the control of physical settlement. And so with them taking away, I think the paper gold market's days are numbered, and where gold will trade, if it is used for sort of settlement for a lot of developing countries, I think it's going to be a lot higher. And so once I worked out that, I wanted to kind of search the whole gold space, looking for someone that had like kind of like a out of the money call option on gold that wasn't being valued, was having almost no value assigned to it. And silver, I kind of view silver as like almost a sort of a a derivative of gold, sort of a call on gold. It'll trade with more volatility and probably outperform gold ultimately. Just been more illiquid, and yeah, I can dig into that more if you want, but that's my,
Yeah, I do.
my kind
I
of
do
view.
want to talk about silver a little bit deeper here in a moment, but I wanted to ask you this other question on gold. The secular gold bull market truly has not begun until capital moves out of conventional financial assets and into gold. That's been historical. Now, what you just described is different and could still definitely set off. It's big enough; it'll set off the gold price, but Ferg, is this something that you're watching, which means the capital movement out of conventional financial assets and into gold? Are you watching that, or are you strictly watching the settlement side, and that has your attention?
I'm actually not that top down with macro. Like, I've just succumbed to my process. I'm more focused on the sector itself, and particularly the company's financials. I want, like, most of my picks come from like where I'm wanting to get in at the absolute bottom when something's hated, often popping out the back of a bankruptcy or restructuring. It's often call it sort of a flat line, or kind of the just being left for dead, hated, and that's where I'm getting in. So I don't use the macro really to time. Any time I have, I've had my ass handed to me. So I don't really, I don't really put much weight in my macro forecasts in that way. I put it more in just when there's enough hate for a sector.
That makes sense. So let's go back to silver here. So silver has the dual benefit of being both wealth preserving as well as an industrial use value asset. While silver has served as historical currency, its superior conductive properties are extremely needed in the global energy transformation to create more efficient power. So silver has been running, as you know, ever larger deficits annually for the last 4 years. There's not many primary silver mines out there. I think maybe less than a third, between a quarter and a third, are primary producing silver. In your analysis, is silver gearing up for massive gains?
Yeah, I think it is. And the issue I have with silver is the expression of the view. So how to actually play it, because I hate being in miners. I really try to limit the amount of miners in my portfolio, as there's just too much that can go wrong. That it's a really hard business, and anytime I am tempted into a miner, I usually want to have multiple things, kind of multiple tailwinds working, and I haven't actually found a way to kind of express that with silver. So I actually don't have any silver in my portfolio at the moment. I do have some gold exposure. I actually like platinum group metals more than silver here, and that's just because I feel there's more factors working in my favor than silver. But that's by no means to say I don't think silver will do really well. I just haven't found a good way to express the trade, and so that's why I've kind of passed on it currently.
So I do want to get into platinum here in a moment, but I just want to touch on miners here. I got a couple of questions for you. So Ferg, at current gold prices, gold miners are really minting money with their expanded margins, and they haven't caught up back to the rising gold price. And so if gold prices keep moving, the margins keep expanding. Is this a great setup for gold miners right now? For them to
Yeah,
have another bull market?
no, sure is. I think anyone that has a basket of gold miners will do really well moving forward, because they've had a rough time. You've only got to look at like GDX, like it's been really really rough for a while, and it hasn't really even performed that well recently, because it's interesting if you even dig into some of the flows within some of the ETFs. I think it was GLD, which it was the first. If you looked the last 12 months, even though gold price was going up, the share issuance was going down, and that's just a reflection of there's still not that much interest in gold in the West. Like, it's the speculative side of it anyway, and it's mostly kind of in the East and also Japan. And yeah, I feel that's all coming. And I think anyone positioned in any of this will have a great few years of outperformance. It's just, again, coming back to, I'm just trying to work out what the best risk reward will be within the whole commodity space. And for some, I might be really bullish on the commodity. I just can't find a clean way to express it. So I just move on.
I understand that. So I got one more mining question for you. It's during the Great Depression, when deflation roared, homestake mining was the big winner. In the 1970s, stagflation was roaring. The metals and miners were the big winners. In the early 2000s, inflation was roaring. Metals and mining companies won big. Now we're in this fiscal dominance scenario where we'll probably have higher inflation and stagflation going on. Do you expect miners to again be big winners like we saw during the Great Depression, the 70s and the 2000s, when stagflation, inflation, deflation all roared?
Yeah, I do. I think across the board, they'll do really well. Granted, you've got to be selective, because as seen across the board, there's a lot of sort of trends that can trip you up. Like just to list a few, you've got some countries are running just stupid energy policies. That means if anything does well, they'll jump in this. I'm just thinking of Australia with their them just smashing the coal companies with royalties, and then taking the gains and just handing out cash to all the citizens as a sort of a here's some cash to help with your energy bill. It's just, and then you've got where I live in Indonesia, got the fact that they are talking about kind of essentially nationalizing their commodity industry. They're not going to export the raw materials anymore. They want to value add, and they've had periods where they've just shut in their production to try and incentivize that. And similar is happening across countries in South America. So it's fine to have. There's nothing more frustrating in this game than having a mining company that's like got a great resource, well positioned for a commodity bill, and lose money because of geopolitical risk. Yeah, right. And so that's the big caveat with saying like miners will do fantastic. There'll be some that'll be absolutely crazy returns, but there'll be a lot that get taken to the woodshed because of geopolitical risk and others.
So you don't necessarily see a rising tide raises all boats. You actually see pockets, some doing great and some doing poorly.
Yeah, to an extent. Yeah, I think there'll be a lot of disaster stories. Well, there already is. Like I've managed to position myself in a few of them, like the likes of Nigeria with uranium. It's just, you can argue the economics and how good the project is all day long, and you still
and then something like that happens.
Yeah.
So you mentioned platinum earlier. Electric car sales, they're plummeting. Auto manufacturers globally, they're halting plans for electric vehicle manufacturing hubs. Clearly, electric vehicles are not the future many thought that they would be just a couple of years ago. Hybrids, on the other hand, they seem to be the future and the preferred customer choice. Meanwhile, platinum group metals supply looks abysmal. So, Ferg, how bullish is this for the platinum group metals complex?
Yeah, I'm a huge bull on it. I love this whole play. As I always, from the start, when I was always kind of suspicious of a lot of the projections of EVs. Living in sort of a developing country, could see I had a lot of friends that tried EVs and electric scooters, and it just didn't work. With the infrastructure wasn't there. Most people didn't have the parking space, the ability to charge it all night. The range wasn't there, and it just didn't make sense. Anyone that bought an EV or an EV scooter, I had a friend that bought one, and he had to get rid of it after 6 months, just because even the mileage that it's marketed, you had to turn it on sport mode to actually get any sort of performance that was reasonable out of it, and then that cut its mileage in half, and then he couldn't do some of the everyday tasks on it. And so I see EVs really disappointing moving forward. But with that said, I see hybrids doing really well. And you can see this, as you mentioned, across the board, like the hybrids sales are going really well. And this is, if you just dig into BYD numbers, like a lot of the Western kind of examples of it want to kind of blend in plug-in hybrids and battery EVs, and they don't really separate them out. But if you separate them out, you see BYD, half its production is hybrids. And if you go into China's like best-selling vehicles, of the top three, the top two are hybrids. And I think when you just see how that makes sense across the rest of the developing world, I think those are just going to continue to outperform. And lastly, Louis Vincent Garve has probably got some of the best research within China. He was sort of wrote a piece on EVs that I found quite interesting, in that a lot of the sort of initial outperformance of the just pure battery EVs in China was actually just mandated by state entities. And so that was what a lot of people were sort of projecting off. And if you actually separate out state entities from retail, then it was always it was the plug-in hybrids that were always the ones that were going to be the ultimate winners. And so, yeah, that's why I kind of dig into that, and I wrote quite a long post on it, was once you understand that, you understand that the story of catalytic converters essentially going away is not the case, because the way a hybrid works is obviously you got a battery and an internal combustion engine. Because it needs to switch between the two consistently, there's actually a need for more catalytic converter, combined with just stricter regulations across the board. And it's one of those few things if you dig into the regulations, with the transition, a lot of developing countries kind of shrug their shoulders with a lot of the sort of demands from the West for meeting sort of emissions reductions and stuff. They don't really care, but they do actually care a lot about reducing sort of emissions from tailpipes, and that's largely on the back of, like, no one wants the smog situations that China went through and India went through. They actually they do enforce that, and so that those two factors just means there's actually an increase in demand for catalytic converters. And this is as a time when you mentioned that there's deficits moving forward, and it's a pretty funky cost curve when you dig into PGMs. Like, you've got Nickel produces just under a third, and it's actually a negative cost because it's a byproduct, and so that doesn't really react to sort of economics. If you're producing something as a byproduct, it's not as straightforward as just mining and stuff and trying to produce more when the cost goes up. Makes it a bit more complicated. And then you've got a third that's just getting by at the moment, and some of it's making money, and then you've got a whole just under a third now that's under the that's above its cost curves above where current prices is. And that's kind of reminds me a bit of some of the other stuff I've looked at, like uranium. I did make the comparison in a recent piece that Sibanye Stillwater's threatening to kind of put their Stillwater mine into care and maintenance. And if they did that, they would remove about 7% of global palladium production. And if you kind of compare that to like Cameco, and they took off, I think, Cigar Lake, that was what, 10%. If you use kind of whatever, about 10% at the time, give or take. And yeah, we'll know how that kind of has played out since. And so, no, and then you've also got the fact of just how much the supply is concentrated in one place, in a pretty dysfunctional place in South Africa. And we've granted it's shored it up a little bit with the government now having the Democratic Alliance and coalition with the main party, the ANC. What kept a lot of people out of South Africa was the concerns with the other party perhaps getting into power or forming a coalition that economic freedom fighters. They were talking about sort of nationalization of mines, and so a lot of people were like, I just want nothing to do with that. So yeah, I love that whole trade.
So you mentioned uranium. There isn't only a shortage of physical uranium, there's a shortage of good uranium equities. Ultimately, that should
Yep.
put a premium on the ones that have trustworthy management, good projects, and the ability to grow. What's your base case for uranium and uranium equities?
Yes, I'm a massive bull on uranium. It's I yeah, I wish there was a better way to express the view on uranium than obviously with the equities. They're a volatile ride, and a lot of them constantly disappoint me. But ultimately, they've been very lucrative financially as well. They have been a good way to express it. Granted, I would have probably slept better if I just put the whole amount of money in physical uranium and had played it that way. But it doesn't give the same level of leverage. So if you're prepared to stomach the volatility, I think selecting the right uranium equities has been the right way to go. Still, my view for the overall space is I expect more fireworks moving forward, and that's just purely on supply demand. It's one of the few sectors that you can actually kind of know demand. Like it's nothing crazy to work out how many operating reactors there are, how many are under construction, and come up with kind of a reasonable demand number that has to be met. And then you can go across the mining space and work out where's production at and who's coming on, and is that going to meet demand moving forward? And that's conservative demand, not adding in a whole lot of like the obviously recently the sort of 70 to triple nuclear, and like not adding any of that in. Just stay with the conservative demand, and it's still falling about a quarter short by sort of beyond 2030, and that just means price is going to have to go a lot higher, and there's going to have to be a lot more capital flow into the sector to rectify that issue, because a lot of the bear cases have proven to be completely incorrect. If you go through Zataprom, their misses alone have pretty much wiped out everything that's expected in the next 2 years from the developers. And then you can just start going through developers that have had issues, whether you just could run through everyone in Nigeria. You've got Govex having its license obviously taken off it, and you can try and guess when Global Atomic will actually manage to get into production, but it's certainly not the guidance they had a few years ago. Yeah. And yeah, I still like the sector.
So SunPower, once a preeminent name in the U.S. solar industry, they filed for bankruptcy in 2021. At the peak of the ESG bubble, SunPower was worth more than $9 billion. The other day, it was down to approximately $200 million. Ferg, is this a strong indicator that the tide is shifting away from clean energy and back towards fossil fuels?
Yeah, I think so. Right from the start, I've always been beating the drum that renewables didn't make sense. I've wrote quite a few posts on it, and just from a sort of an energy return on investment standpoint, they don't hold up. They could go through all the reasons why solar doesn't make sense, apart from a few situations that make sense if you've got a lot of very cheap land surrounding, like some places in the Middle East, and they operate quite a fossil fuel heavy grid anyway. They can benefit from solar, but people like Germany putting it in, it's just ludicrous, because not only do you have obviously the day and night fluctuations, you've got the fact that the capacity rates and capacity factors nowhere near what it should be. I think Germany averages 9-10%, where the nameplate capacity on most of these is like in the 20s. And then you've got seasonality, where summer is 50% higher output than winter. And so you can't manage that in a grid. You can't manage that even with batteries. It's just a non-starter. And so I always knew that was just completely flawed. And I've been taking the other side of that, mainly with nuclear and coal. I just always said nuclear is what we should be doing, and so that's the ultimate winner. And coal's kind of the break the glass situation. When you do enough dumb stuff, you have to switch back to it, as Germany's kind of proved.
That's a good way of putting it. They've done a few dumb things, yeah. So when the dust settles, oil fundamentals, they're strong. Inventories are drawing. The Middle East is on the brink of war everywhere, and the likelihood of energy infrastructure getting targeted in that region of the world, it's not zero, and it's growing. Do you see this as a situation where those investors who stay calm and stay the course there will be rewarded? And what parts of the energy chain do you find the most value?
Yeah, sure. So yeah, I'm still a big oil bull. Bought a whole lot more kind of oil exposure in the last few days. I saw a big opportunity recently with oil volatility, trading near all-time lows, which I found fascinating considering everything going on. It's kind of crazy. It obviously coincided as well with inflation expectations being sort of all-time low as well, and just wanted to take the other side of that. So I do have some option futures playing that, but the vast majority of my way of expressing the oil trade has been through oil services, and this is just I adore the opportunities you get when you have a super cyclical sector that can't make it to the recovery and goes through a bankruptcy phase, writes off a whole lot of debt, and pops out restructured and very asset heavy. So all that debt gets written off, and you get to jump on all the assets on the other side and be alongside a lot of the debt holders that get debt, usually have a debt for equity swap. And so you're actually alongside a lot of the smart money in these, and you can have a great outcome, and you've got a really big moat around it. And so that's been my way of expressing it. And yeah, everything I read at the moment, there's so much kind of even a lot of the commentators, the energy views are still seems to be split down the middle. Some people stay in the course, and a lot of people that are saying no, it's not the case anymore. And my take is I'm still firmly focused on shale, and in particular the Permian. And to me, it looks like a lot of the so-called productivity gains were really just overproducing the assets in hope of M&A, labeling sort of productivity gains, when really it was it's just working through high grading quicker, if you will. And so it's not going to hold up. And granted, the timeframes are off, and it's been it's taken longer, but then that's almost a standard with everything I've got into, particularly uranium. Yeah, I'm no market timer when it comes to inflections. I usually get in early and have a rough time until the inflection comes. But when it comes, it makes it all worth it. It's kind of how my experience with multi-baggers work.
This has been a fantastic conversation. Before we wrap up here, and I asked Ferg our final question, I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct. Just like this one, they're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive this free gift on us. Also, I'm positive that you've enjoyed the conversation with Ferg as much as I have. Please let him know by hitting the like and subscribe button and leaving a comment below the video. It's now time for our Golden Nuggets segment. Ferg, let's discuss portfolio positioning. Based on everything we've discussed today, with your experience and your worldview as the backdrop, how are you positioning for the next 12 months? What assets do you like, and what assets do you absolutely want to stay away from?
So assets I absolutely love at the moment, still oil field services. I reckon across that space, there's some bargains that are only just leaving the train station and platinum group metals. If you were to hold me to two at the moment, that would be where I would still be loading the boat at the moment. Those are the ones that, I really like, and something really stay away from, probably Nvidia and Mag 7. couldn't pay me to own them here.
So, Ferg, thank you for coming on to Metals and Miners and for being so generous with your time and your analysis and your ideas. It's really been incredible to spend the time with you. Would you please share with the viewers what's the overall theme that you want to leave with those tuning in, where they can learn more about your work, and how they can connect with you?
Sure. Well, thank you so much to start with for having me on, Gary. And I just write, which is generally just about my portfolio and how I'm positioning at Trader Ferg on Substack. It's just what I'm doing with my money, essentially, and how I'm trying to pretty much hunt through the whole real asset space to stay ahead of the Fed's balance sheet. I guess that would be the simple summary. I just want to find what's the most hated with the best sort of supply demand, and off 99% of people's radar. Like my most recent purchase is something that's gone bankrupt twice, and even when they paid out a creditor, they then they immediately dumped it. So it's just really hated, and I love that stuff.
Are you also on Twitter, X?
Yes. At Trader Ferg on Twitter. Yeah, I don't use Twitter as much anymore. I check it maybe once or twice a week, but yeah.
Okay, well, I will put your Substack information, your Twitter X information. It'll all be up here in this area of the video with links. Everybody go follow Ferg. He's a must follow, a must read. Check out his Substack. Very important, especially in these times. We're in early innings, as he's already described throughout this video here today. But the train could be leaving the station soon. I look forward to having you back on, Ferg. Thank you for being here with us, and everybody else, thank you for watching.
Cheers, Gary.
I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct. Just like this one, they're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise titled, "If you don't own gold, you know neither history nor economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive this free gift on us.